That's right. I mean, the Fed oversight is of a group of people, and that's oversight of bankers. So the first recipient of even more quotable ire should be on the bankers that mismanaged Silicon Valley Bank, top to bottom. But bank supervision is about the collaboration and sometimes the confrontation between government and banks over these very questions of risk management. And I think the Fed so far, based on the information we have now, which is limited, we can say that the Fed supervisory process is badly broken.
So all of that may be the case, and I want to circle back to it. But conceptually, it's interesting to look at what happened in 2008 and say, along with many other things, money market funds lost money and broke the buck, and there were some runs and people took their money out. We ultimately had to step in and backstop them. In 2023, who would have thought that all played out again? But in bank deposits, the banks were the ones who lost money. The depositors over 250K, we just didn't realize how much that had grown. They all took their money and ran. And is the simple solution to this basically a fix that sort of keeps some guardrails in place for the risk they can take in exchange for the FDIC insurance they'll get?
I think that's exactly a great approach. What I didn't hear you say is that we should therefore apologize to these very wealthy people for the inconvenience they had for a few hours before they received their guaranteed government support. What we should be doing is right-sizing, as you say, the kinds of risks that they're taking and the benefits they received. What they received was non-priced insurance, ultimately from the government.
Right.
And on top of that, a suite of financial services that was valuable to them. And in exchange, they subjected themselves initially, and then all of us eventually, to outsized and asymmetric risks. So we need to get the regulatory and supervisory system much better in place. And part of that is making sure that these insurance products, explicit or implicit, are well priced in such a way that there will be buyers and there will not be buyers who decide that their risk management strategy would be better off without paying for those services.
And I guess the reason I raise it is to say, if this can be fixed with a more or less a tweak by Congress, changing the rules of engagement going forward to make sure that this doesn't reveal a systemic weakness, then how much of it really is the fault of Fed regulation? Now, I'm not trying to say they didn't fail. They obviously did fail. I mean, this was there were problems that this bank flagged back to 2015. There was no risk manager in place for a while. There were issues. So it's more, I'm just saying, if I'm so cynical that I expect them to fail, isn't it better? I think this was an Aristotelian thing. It's sort of, isn't it better to set up the law because we trust the law more than we trust the people who might be interpreting it?
So I like that invitation to Nicomachean ethics. Here's where I would say we need to be a little bit more utilitarian. And it's not cynical to recognize that there's important government slippage in the clarity with which Congress and regulators can write rules. It's not cynical at all. In fact, we created an entire bank supervisory system to recognize that whether we're talking about Amazon or your local food truck, the government is not similarly situated to businesses everywhere. With banks, it gets a desk in the building, and it gets to ask questions, to second guess about risk management. The entire reason is because there's slippage on these very issues.
True.
The entire reason for bank supervision is that these rules aren't self-enforcing. What does it mean for a bank to be safe and sound? We don't even have any kind of sense of that. So,
well, I mean,